In today's video, I'm going to walk you through the available research talking about diversification when it comes to investing. We'll even look at the original theory. We'll dig into peer-reviewed studies, and I'll even show you some of the surprising limitations of diversification. By the end of this video, you'll know exactly if diversification reduces the risk when it comes to investing, and how you can use this knowledge to build yourself a smarter portfolio. Before I start this video, I want to make it abundantly clear that nothing in this video is financial or investment advice. All investing carries risk, and you should always do your own research when parting with your money, whether it's in stocks and shares or anything else for that matter. So what is diversification? Diversification simply means spreading out your investments across different assets so that if one does badly, another might do well to balance it all out. So the idea originally became famous in 1952 when economist Harry Markowitz published a paper in the Journal of Finance called Portfolio Selection. So in this paper, Markowitz mathematically proved that if you combine assets with different levels of risk and return, you can actually reduce the overall volatility of your portfolio without necessarily having to give up returns. This became the foundation of something we call the modern portfolio theory, which later went on to win the Nobel Prize in Economics in 1990. Think of it visually. Imagine just holding onto one stock. Its line goes up and down like a roller coaster. Now imagine combining it with another stock that moves differently. Suddenly the line gets smoother. That's basically diversification at work. So here's what the research shows. One of the most famous studies came from Markowitz himself. He showed that combining uncorrelated assets can dramatically reduce volatility. But how many assets do you actually need? In 1987, a researcher named Meyer Statman found that holding around 30 stocks gives you most of the diversification benefits of the entire stock market. Later studies like a 2001 paper by Campbell et al. In the Journal of Finance found that the risk of individual stocks, what's called idiosyncratic risk, has actually increased over time. In plain English, this means just picking a few individual companies has become riskier, and broad diversification has become more important. So the takeaway here is pretty simple. The evidence shows that broad diversification, whether through holding 30 or more individual stocks, or just using an index fund or ETF, is far safer overall than picking just a handful of companies. So if you would like to get started with investing on Trading 212, you can get a free fractional share worth up to £100. All you have to do is to use the link in the description box down below. Now, alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received your free fractional share, then all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see the section Use Promo Code. And in this section, just enter my code JUBAIR and you should receive a free fractional share. So what are the limitations of diversification? First, while it reduces unsystematic risk, that's risk tied to individual companies, it can't eliminate systematic risk. That's the risk of the entire market as a whole. If the global economy crashes, your portfolio will still crash. Secondly, there's an issue of home bias. A famous study in 1991 by French and Poturba showed that investors all around the world overwhelmingly pick their own countries to invest into rather than looking elsewhere, even though global diversification would reduce their risk further. Thirdly, there's something that people like to call diversification. After a certain point, adding further assets to your portfolio may not meaningfully reduce your risk. And while it might feel like you're improving your diversification, this could actually have a negative impact on your total returns. And finally, history gives us a clear-cut example during the financial crisis of 2008. Even investors who were diversified globally saw a big crash in their portfolios. In these cases, diversification surely cushioned the blow, but it did not completely prevent it. So what are the real-world applications of diversification? So ETFs and index funds could be your best friend. A global ETF, for example the Vanguard FTSE All Cap, gives you exposure to thousands of companies instantly. That's diversification that you could probably never achieve on your own. Mixing different asset classes matters more than just mixing stocks. A study by Ibbotson and Kaplan in 2000 showed that asset allocation, the mix of stocks, bonds, and other assets, explains over 90% of the variation in portfolio returns. If you're going to diversify, then rebalancing is essential. Let's say you start with a 60-40 portfolio. That's 60% stocks and 40% bonds. Over time, stocks may outperform the bonds that you hold in your portfolio, and suddenly your portfolio becomes 75-25. Rebalancing brings you back to your original target, reducing your risk overall, which keeps your risk under control. You need to look beyond your home market. For UK investors, relying only on the FTSE 100 exposes you to a very narrow slice of the global economy. Academic research consistently shows that global diversification leads to smoother returns with less risk. So the research is pretty clear. Diversification can reduce risk. You only need about 20 to 30 stocks to get most of the benefits, or even simpler, just buy a broad ETF. But diversification isn't perfect. It won't prevent you from global crashes, and adding too many assets can water down your returns. The most effective strategy, according to a wealth of knowledge academically, is to diversify across companies, across industries, across countries, and to balance stocks with other assets such as bonds. Here is a simple analogy. Building a portfolio is like building a football team. If you only have strikers, you'll score some goals, but without defenders, you'll also get destroyed. Diversification means having strikers, midfielders, defenders, and a goalkeeper. You can still lose the match, but your chances of winning increase dramatically. So does diversification reduce the risk? The studies seem to show that it does, but only with the risks that you can control. The smart move is to probably use ETFs or index funds to get instant diversification, and with that you don't really have to worry about rebalancing, and all you have to think is globally. So make sure to check out some of my other videos, and I'll see you in the next video.